Exchange-traded funds. If you are new to trading, I recommend using exchange-traded funds, or ETFs, rather than buying individual stocks. You can think of an ETF as a basket of stocks. They offer diversification so you don't have too much risk in one particular stock. ETFs can be a good way to invest in a general theme without having to worry about specific events. So with an individual stock, there could be an earnings gap down where a stock gaps down on an earnings report. There could be a statement by the CEO. There could be some sort of news event. So you don't have to worry about that as much with ETFs since it's a basket of stocks rather than one particular stock. Some ETFs are less volatile than individual stocks and may be less susceptible to very large overnight moves or gaps. Whereas an individual stock may never return to old highs, broad-based ETFs such as SPY, which tracks the S&P 500, has a long track record of returning to old highs. So let's take a look. This is a chart of the S&P 500 all the way from the early 1920s into 2019. Notice there are booms and there are busts, but the overall track record is around 10% a year. Okay, so this is why I recommend starting out with ETFs, especially SPY, which tracks the S&P 500. The reason why I recommend this is because there's diversification and there's a long track record of returning to previous highs. So there will be booms and there will be busts, but the overall trend is about 10% a year. Okay, so that's why I recommend avoiding individual stocks if you're just starting out and stick to ETFs such as SPY since they offer diversification and they have a long track record of performance. Now, here's what I want you to look at. Here's how I would use SPY with the indicators that we discussed. Can you spot some of the clues that we talked about in the course that show you that a bottom may possibly be happening in March 2020? Now, in hindsight, we know that the bottom happened, but you don't know that as it's happening. You can only make an educated guess by putting some clues together. So pause the video now and look at the chart from 2020 and say, what were some clues that the bottom was in? Well, you can see a few things. One, we saw some support here off the $220 range down here. RSI was oversold here. Now, here's why I say I don't like to make a trade just off RSI, because see, it was oversold at this point, and you get a little bounce, and then it fell farther down. So that's why you got to be careful with using just RSI like that. We see we had a MACD cross down here, and then we had a retake of the 20-day moving average. So this is how I would bring in all of these tools together to make a decision. So I would be looking at SPY and I'd say, well, we were recently oversold on RSI and we're a little oversold again here. We had this bounce off support. We had some nice volume coming in here off the lows. And now we have a MACD cross down here. So you could take a position in SPY somewhere in here, in this range here, and then you could put your stop loss down here. Okay, so that is how you put it all together. And because you're in the S&P 500, you have some diversification. You don't have to worry about, the CEO saying something or anything like that. It allows you some flexibility, and you know that the long-term track record, as we saw over here, is around 10% a year. Okay, so there'll be booms and there'll be busts, but the overall trend is about 10% a year. So it gives you some flexibility and it allows you to sleep calmly at night, knowing that you have diversification and you have a long track record of success behind you. So which ETFs can you use? Well, the number one I would recommend would be the S&P 500 ETF SPY. If you don't want to use that, you could also use the NASDAQ 100, which is QQQ. That represents Amazon, Apple, a lot of the stocks like that people are really, really into. So that allows you to participate in a lot of the tech moves in an easy way. So SPY and QQQ are the ones I would recommend the most. If you want to get into financials, you can use XLF, XLE is energy, TAN is solar, XLK is technology stocks, XBI is biotech. So these are some very popular ETFs. Rather than buying a biotech stock, which can be very risky, you can just do XBI instead. Some other ones I would recommend would be IWM, which is the Russell 2000, XME, which is metals and mining, GLD, which is gold, and SMH, which is semiconductors. Okay, so just using those ETFs can allow you to participate in the stock market as a new trader without having to get into an individual stock. The ones I would recommend the most are SPY and QQQ, especially SPY. If you're just starting out, I would use SPY, and then you can move on to QQQ and some of the others later on. Please, please, please be careful with leveraged ETFs. I would not recommend using leveraged ETFs. What a leveraged ETF is, they take a move. Let's say the regular ETF was up 1%. The leveraged ETF will be up, let's say, 3%. Okay, so they'll have the SPY ETF and they'll have the leveraged SPY ETF. So the leveraged SPY ETF will often be like 3 times the move. Okay, so if the S&P 500 is up 2%, it will be up 6%. So it sounds great if things are working out, but it's terrible if things go wrong, and things will go wrong in the stock market. So please, please, please do not use leveraged ETFs. I also recommend starting out really, really slowly. If you're in your first 6 months to 1 year of trading, I would trade extremely small. Maybe even just buy 1 share just for the practice. Don't worry about making money your first few months. Worry about not going broke. When you first start trading, you're going to be at your worst. So why would you pay a large tuition fee? Because you're going to make mistakes. Okay, so you'll make a load of mistakes your first 6 months of trading, and I would even say probably 6 years of trading. I've been trading for 15 years, and I would say it took me many, many years to get this down and to make money and be profitable. So what you got to do if you're first starting trading is use as little money as possible, because you will be making mistakes, and you want to be making small mistakes that only cost you a small amount of money rather than making huge mistakes that cost you your entire savings. Okay, so if you have the ability, which we all do, to buy less shares, please buy less shares. What does most traders in is they're not patient. They say, I got to be rich overnight, and they take $20,000 and they put it into one stock, and they don't know what they're doing, and they have no plan, and they lose their money, and then they just give up on trading. So instead of doing that, what you need to do is think about the long term. Think about developing a skill. Think about opening a business, okay? So you want to do it in a slow way, in a controlled way. You want to learn from your mistakes. You want to hone your practice, improve your skills. And then as you get more confident, and then as you have a track record of success, then you can start adding larger positions. Then you could start buying into individual stocks. But please, at first, be patient, and you will make mistakes when you're first starting, but you want to lose as little as possible when you first start trading. Okay, so please, please, please take this warning seriously.